All right, Chapter 11, Property Dispositions. Actually, I want to talk about a couple of things here in this chapter. When you dispose of property, you have to know a couple of things. You have to know in order to determine gain or loss. Of course, if it's personal use property, it only pertains to capital assets. But I'm talking more business and rental and investment type property, some of which are certainly capital assets as well, dispositions. And so you have to know the amount realized on a transaction, as well as what the adjusted basis is of the asset. And so let's talk first of all about amount realized, because the difference between amount realized minus the adjusted basis of an asset is the amount of gain or loss. Amount realized by a taxpayer from the sale or other disposition of an asset is everything of value from a buyer less any selling cost. Now understand, remember, any type of transaction that affects property rights by the taxpayer, is potentially taxable. And it can be a sale where all they're receiving is cash. It can be an exchange of property, but it could be a combination of the two as well. And so the formula for figuring out the amount realized is cash received plus fair market value of any other property received plus buyer's assumption minus seller's expense. Now, why would the buyer's assumption of liabilities be added to the amount realized? Well, let's say I have property, and let's say it's worth $10,000, or excuse me, $20,000. And it's an arm's length transaction, so, you know, both parties want to get what they can, the fairest deal possible, right? And so the buyer gives, and this property that is sold for $20,000 is subject to a $10,000 liability. What is the buyer going to give the seller? And the seller is the taxpayer in this instance. Well, if it's an arm's length transaction in that scenario, what the buyer would give is $10,000 of cash received if they're assuming a cash or a liability of $10,000 also. Just makes common sense. Now, you know, might there, you know, not every deal, even if it's arm's length, is not always fair, but at least in theory, that would be your ideal transaction. Well, it's as if, what has happened there where the buyer has assumed a liability? It's as if the buyer gave $10,000 to the seller, and the seller turned around, the seller taxpayer turned around and paid off that liability. So that's why you include the buyer's assumption of liability in the transaction of the seller as amount realized. Now, we talked about the adjusted basis of an asset when it's purchased, but there's other types of ways you can acquire an asset. It could be through gift, it could be through inheritance, you can also convert personal use property to business property. So what's the basis in those types of assets? Because we talked about the basis for something that's purchased. Well, for a gift, if you receive property as a gift, it kind of depends on the fair market value on the date of the gift as to what the basis, the initial basis is. If on the date of the gift, the fair market value of the asset gifted is greater than the donor's basis, then the donee's basis is a carryover basis. If on the date of the gift the fair market value is less than the donor basis, then the donee, not the done, the donee uses a carryover basis if the asset's later sold for a gain. If the asset's later sold for a loss, then the donee uses the fair market value as of the date of the gift for the basis. So you've got two types of bases. Depends on what it's sold for later. If the fair market value is less than the donor's basis, then you've got this two-tiered approach you've got to use when you dispose of the asset later. And so this dual basis rule prevents the transfer of unrealized losses from one taxpayer to another by gift. You could, if this rule didn't exist, you could essentially transfer your loss to someone who needed it or wanted it. For inherited property, this is by will or by what they call the laws of intestacy. The heir's basis, that's the one who receives the property, is the fair market value on the date of the decedent's death. Now there is an alternate valuation date 6 months after the date of death to determine the basis if they elect to do so. Now for property converted from personal use to business use, the basis depends on whether the property appreciated or declined in value during the time the property was used personally. Now in most instances, if it's like a car or something like that, it's declined in value. But just for the record, if it's appreciated in value, the taxpayer uses the basis of the property, what the taxpayer originally bought it for. If it has declined in value, the taxpayer uses the fair market value on the date of conversion from personal use property to business use property for determining loss.